What if everything you believe about money is wrong? Because here's the strange truth nobody wants to admit. Stocks crashed in 1929, bonds collapsed in the 1970s, real estate was wiped out in 2008, crypto evaporated in 2022, and currencies, banks, and governments have failed again and again. Yet through every crash, every panic, every inflation wave, every recession, and every global meltdown, a small group of assets quietly survived. Three positions that most experts ignore, laugh at, or completely misunderstand. Today, we uncover the strange story of what survived the Great Depression, the inflation crisis of the 1970s, the global financial meltdown of 2008, the sudden collapse of 2020, and the everything crash of 2022. A portfolio so boring, so simple, and so ignored that it almost feels like a mistake. But it isn't. It's a blueprint that has been hiding in plain sight for nearly a century. So the real question is, what exactly survives when everything else dies? And why has no one told you the full truth? To find the answer, we need to go back. Back to a time before index funds, before financial influencers, before algorithmic trading, before stock apps and crypto charts. A time when the economy was raw, emotional, and dangerously fragile. Because history has a pattern, a brutal, repetitive pattern that nearly every generation forgets. Each cycle follows the same rhythm. A boom fueled by confidence, an explosion of debt, reckless speculation, a shocking trigger, a violent collapse, desperation, reforms that fail, then a new boom that sets up the next disaster. The pattern never changes. Only the technology does. And in every cycle, three assets, cash-like safety, gold-like permanence, and government-backed debt, quietly stood strong when everything else fell apart. Not because they were profitable every year, but because they refused to die. This script is the hidden story of that survival. The year is 1929. The world believes it has entered a new golden age. Ordinary people are borrowing money to buy stocks. Banks are borrowing money to lend to people so they can buy more stocks. America is drunk on optimism. The newspapers call it a new economic era. Wealth feels infinite. And then, October 24th, Black Thursday. The first cracks appear. By October 29th, the entire system collapses. The Dow Jones falls nearly 90%. Thousands of banks fail. Millions lose everything. Stores shut down. Lines form outside soup kitchens. The foundations of modern finance crumble. But in this nightmare, something strange happens. Three assets refuse to die. Gold, still held by citizens and central banks, maintains its purchasing power. Cash, especially short-term government bills, becomes the safest thing on earth. And U.S. Treasury bonds, backed by the government, remain stable, even rising in certain periods. While almost every asset is crushed, these three positions stay alive. Not because they made investors rich in the moment, but because they didn't evaporate. And in 1929, not evaporating was the highest form of winning. Fast forward to the 1970s. A completely different crisis emerges. This time, it's not deflation or collapse, it's inflation. Prices rise month after month. Oil shocks cripple economies. The US dollar loses its gold backing. Families struggle as groceries double or triple in price. Stocks go nowhere for more than a decade. Bonds collapse under rising interest rates. Cash loses value every month. But one thing refuses to fall: gold. In fact, it doesn't just survive, it explodes. From $35 to $850 an ounce. A more than 23-fold increase. This is the second clue. Some crises destroy everything except gold. Some destroy everything except cash. Some destroy everything except safe government bonds. But together, all three cover each other's weaknesses. Together, they form a triangle of survival. Jump to 2008. A new disaster. This one isn't caused by inflation or stock mania. It's caused by debt stacked on more debt. Housing is supposed to be safe. Mortgage bonds are supposed to be safe. The banks are supposed to be safe. But one default triggers another. Then another. Then the entire financial system collapses like a house of cards. Stocks fall more than 55%. Housing collapses. Banks fail. Entire countries go bankrupt. The world stands on the edge of a second Great Depression. But once again, the same survivors appear. Cash becomes priceless. U.S. Treasury bills become the most demanded asset in the world. Gold rises. These aren't flashy investments. They're not designed to make you rich. They're designed for something much more important, to keep you alive while the world burns. March 2020, the fastest crash in modern history. Global shutdown. Travel stops. Cities go silent. Markets fall 35% in a matter of days. Investors panic. Hedge funds collapse overnight. The world freezes. Yet again, the pattern repeats. Cash saves investors first. Treasury bills and government bonds stabilize portfolios. Gold becomes a flight to safety asset. The same three pillars return, again. Different crisis, same survivors. And then comes 2022, the year nothing worked. Stocks fall. Bonds fall. The worst bond crash in modern history. Crypto collapses. Real estate slows. Inflation reaches levels not seen in 40 years. Every traditional strategy breaks. Portfolios that were supposedly diversified suddenly behave like a single asset moving straight down. But what survives? Gold holds steady. Cash protects purchasing power. Treasury bills start yielding meaningful returns again. The boring assets, the assets nobody brags about, once again prove to be the foundation of survival. So why does this keep happening? Why do the same three positions survive every era, every system, every crisis, every shock? The answer is surprisingly simple. Complexity collapses. Simplicity survives. Every generation believes it can outsmart nature with more leverage, more derivatives, more financial engineering, more printing, more rules, more aggressive strategies. But complexity doesn't make financial systems stronger. It makes them fragile. And the more complex a system becomes, the more violently it falls when something goes wrong. This brings us to the portfolio that blends simplicity and historical survival into a single strategy. The first version appeared in the 1970s, created by author and investor Harry Browne. He studied centuries of economic history and realized that all markets rotate through 4 seasons: prosperity, recession, inflation, and deflation. Each season rewards a different asset. Stocks thrive in prosperity. Long-term bonds thrive in recession. Gold thrives in inflation. Cash thrives in deflation. So he built a portfolio with equal exposure to all 4. 25% stocks, 25% long-term government bonds, 25% gold, 25% cash. A portfolio so simple that Wall Street didn't take it seriously. They mocked it. They ignored it. But quietly, in the background, it outperformed most complex portfolios, not by maximizing returns, but by minimizing catastrophic losses. It didn't panic. It didn't swing wildly. It didn't collapse in crises that erased decades for other investors. It simply survived decade after decade. Then came Nassim Nicholas Taleb, the risk philosopher and mathematician who predicted rare, devastating events he called black swans. Taleb introduced a more aggressive structure, the barbell portfolio. Instead of spreading investments everywhere, he suggested holding 2 extremes: extremely safe assets on one side, like cash and treasury bills, and extremely explosive, high-upside positions on the other, like gold. Out-of-the-money options, or asymmetric bets with limited downside and unlimited upside. Nothing in the fragile middle. If disaster hits, the safe side protects you. If disorder hits, the explosive side grows dramatically. In normal times, the portfolio quietly waits, patient and unbothered. The barbell approach is not about yearly returns. It's about being unkillable. The third version is the one most people instinctively use without understanding the history behind it. A simple 3-position mix of stocks, gold, and cash or T-bills. It's not mathematically optimized, but it has an ancient logic behind it. Stocks represent the growth of innovation and human progress. Gold represents the failure of governments, currencies, and trust. Cash or T-bills represent the ability to survive liquidity shocks and take opportunities. These 3 forces, growth, permanence, and safety, mirror the 3 survival pillars of every major crisis of the past century. This simple trio quietly survived every major collapse, often outperforming portfolios that used 20 or 30 complicated positions. Now, let's connect everything. Look carefully at the timeline. 1929, the 1970s, 2008, 2020, and 2022. Different crises, different causes, different victims, but the same survivors: short-term cash-like assets, gold, and government-backed bonds. These assets aren't designed for excitement. They aren't designed for bragging rights. They are designed for the same reason a ship has lifeboats. You don't expect to use them every day. You hope you never need them. But when the storm arrives, they are the only things that matter. And the greatest lie in modern investing is that this time is different. Because if you compare today's global economy to the past, you'll see the same warning signs repeating yet again. Debt levels higher than 1929. Inflation cycles similar to the 1970s. Asset bubbles reminiscent of 2008. Currency confidence as fragile as the early 1970s. Geopolitical tension echoing the 1940s. The ingredients are the same. The pressure is the same. The arrogance is the same. And the pattern is returning. So what should we learn from a century of survival? First, growth is temporary, but survival is permanent. You don't need the highest returns. You need to avoid the few catastrophic losses that erase decades of gains. Second, simplicity beats complexity. The more complicated a portfolio becomes, the more fragile it becomes. And third, crashes are not bugs in the system. They are features. They are natural, inevitable resets that expose the truth about what is fragile and what is resilient. The next crisis is not a matter of if, but when. So here is the final warning. You don't need to predict the next crash. You only need to prepare for it. History doesn't reward the smartest investor. It rewards the most resilient, the most patient, the most prepared. Most people chase hype. Most people chase returns. Most people ignore risk until risk becomes the only thing that matters. But you now understand the pattern. You now know the survivors. And you now have the blueprint that lasted through every financial disaster of the last 100 years. If you want more deep dive videos like this, videos that uncover the hidden patterns of money, the forgotten lessons of history, and the tools to survive whatever comes next, hit subscribe, turn on notifications, and tell me in the comments, which crisis shocked you the most? 1929, the 1970s, 2008, 2020, or 2022? Your answer might shape the next video.